Okay, hello to you all, ladies and gentlemen. Thanks for coming along. Going to get started just now. If you bear with me a moment. Okay, so I hope you're all well. It's quite a bit to go through tonight, and we're going to see how we go. It's a bit of a combination of things this evening in terms of market concepts and levels of complexity. So I hope you find them interesting nonetheless. Very much education focused. Now, this session very much in line with previous sessions here. We want to talk about the concepts and how concepts interrelate with each other when it comes to crucial elements that need to be considered when considering an investment or a particular type of investment, or really any particular opportunity. So one of the things that we're always struggling against in this business and in this industry, myself as well, in terms of how I'm trying to help clients, and especially the clients themselves, is the level of misinformation, disinformation, confusion, lack of clarity, and so forth. So we want to do our best to try to put things in perspective and really talk about some very much crucial investment concepts. So I don't mean to overuse that word, but they apply to not just any particular type of approach or market or experience level, very much universal, logic and rationale based effectively, and very just crucial, as I say. So let's do that. Now, a couple of things to get out of the way first, especially for the newcomers. That's me there. Adam Lavaz is my name, and I'll be taking you through this session. And if you pick up the phone and want to talk about the markets or send an email, then I'll be the one to help you with these things. So quick history, as I say, I've been licensed in this business since 2006. I actually started a few years before that in something of an informal way, but I did start with my first real job, you might say, in the financial markets in late 2005, and licensed in 2006 to make it official. Licensed in advisory and securities and derivatives and currencies, foreign exchange, that is. And I formed Investor Unity in 2012, and I really formed it with a couple of key purposes and principles in mind, very much in line with some of the stuff that I've already discussed this evening in terms of bringing a sense of clarity to the industry. The two big problems that I found in the industry still very much remain to this day, and one of them is that people tend to, clients that is, the general investment community or the general investment public, tend to have very strongly, in fact, an over-reliance upon positive market conditions, and over-reliance upon the traditional approach, you might say, and even more so, but very much in line with that, people have an over-reliance upon the industry itself. So I have big problems with the way the industry does a lot of things, certain things more than others, you might say. But I formed this company to try to provide alternatives to these types of things, and to again try to provide at the very least some sort of sense of clarity that people could use to really just try to make the best decisions for themselves, and have a bit of a fair go, which is what most people really just want at the end of the day. So we've been independent from the start, never had any exclusive contracts or relationships with any particular banks or firms, or much further beyond that, in fact. Don't have any exclusive dependency, and this is very much in line with tonight's session. No exclusive dependency or exclusive focus upon a particular market type or any particular approach or strategy or anything whatsoever. We employ very much a first principles approach. which means we get out there and try to find opportunities that have a good probability of success, a good probability of delivering growth, delivering returns with very precise risk mitigation capabilities. Really want to protect the downside first and foremost, and I'm going to be talking about that a lot throughout the throughout the session there. But as I say, and as it says on screen there, sole interest really is aligned with and focused upon the long-term success of the clients, which is what we all want at the end of the day, I hope. So, talking about the different types of services, there are two. We separate them into two broad categories in terms of how the client may wish to take advantage, or effectively what the client is really looking to do. So that means they're separated into hands-on versus hands-off type services. So the hands-on type services come in the form of alerts and recommendations, live market sessions, and the IU Academy. All of this is structured within what's called a VIP membership, but again, this is just for people that do actually want to get hands-on, learn new strategies, learn new approaches, place their own trades, manage their own risk, and do everything, or do at least a reasonable portion of things themselves. Now, the other side of the business is much simpler, much more straightforward as such. It's the hands-off side of things. This is for people that don't want to do all those other things. They really are just looking for peace of mind, proper returns, straightforward answers, a sense of clarity, as I tend to harp on about, and that comes in the form of the managed strategy portfolio, as it's called, and that really is going to be the focus of tonight's presentation. In fact, it's the focus of the business. It's the other side of the business is relatively new. The majority of people, the majority of the population, and the majority of our clients are really just looking for this hands-off type approach and just have things taken care of for them. So on that, in a little bit more depth, and just to be clear, there are no setup, administration, management, or monthly fees or exit fees if you change your mind at any stage. Now, to clarify things there, on the monthly fees side of things, there is, as of fairly recently, an additional choice that you'll see on the website if you go digging through. There's an additional choice there now that if you do want to pay a monthly fee, then you can do so. It's just a fixed monthly fee. Otherwise, you just pay for your trades. You just pay for your buys and sells, effectively, entries and exits. You just pay a simple brokerage fee, which all up is really very low relative to your account size and so forth. But as I say, that's just one of the choices. Most people just want to keep it simple and pay for their trades only. So no setup, administration, management, or monthly fees or exit fees. There you pay for your trades only. No lock-in periods or nasty catches. Funds remain in your account, that is, with the broker of choice. We're going to be talking about the broker later on. But that's very important to understand. Despite any licensing or qualifications or experience or accreditations or any of these other sort of things, you don't need to worry about your deposited funds. So the funds are going to remain in your account with the broker, and then you simply authorize Investor Unity, ourselves, that is, to place buy and sell orders on your behalf. So we neither have access to or receive your funds simply because we don't need to. We just are applying a strategy to your account as part of the managed strategy portfolio service, I should say. Ultimately, services are very easy to set up and extremely easy to monitor, and again, withdraw from if you do change your mind. You're not locked into anything at any stage. Now, getting started, if and when you're ready, when, what you would do is you would set up your own fully independent account. And I want to get a lot of these things out of the way at the start, because again, a lot of times people have been to these presentations and workshops and seminars and so forth, and you get hit with the nasty surprises at the end. So I just want to get it all out of the way at the start to make it really nice and clear. If you do want to get started, it's very, very easy. You set up your own fully independent account, and you're effectively setting this up as if you're going to manage it yourself, as if you're going to trade/invest it for yourself. Once it's established, you then deposit your initial capital into the Commonwealth Bank client trust account. So that's the Commonwealth. The Commonwealth Client Trust Account is the account structure that the broker uses. You don't need to set up a Commonwealth Bank account. You just deposit it into the client trust account. It's a segregated client trust account that's set up under Australian Securities Investment Commission ASIC regulations to the highest degree possible and so forth. And that's how you actually see the funds deposited or appear in your account, in your own independent account. Once again, and then once that's done, you then fill in a little online form. It takes about 2 minutes, and you're just effectively authorizing Investor Unity, ourselves that is, to connect your account to the Managed Strategy Portfolio, the MSP service. So all that means is that once your account is set up, you then take that additional step, and we then connect your account up, which means that when we place a buy or sell for ourselves and for the rest of our clients, you receive that on your account also. So everything just runs in sync from that point forward, and you just basically view your account in. You can view your account in real time. You can deposit extra, withdraw, as I say, as you please. It's completely up to you. So I hope that makes some sense, and let's get back to the main sort of topics at hand tonight. Quite a bit to go through, as I say. Now, I want to think about what we're really trying to achieve here. Again, and I can't stress this enough, and I hope you don't get too sick of hearing me carry on about it, but there's a lot of confusion out there in the industry. A lot of you know this already. I know that you know this from speaking to so many clients. It's so incredibly common, and basically anyone that spent more than 5 minutes on the internet knows just how confusing these things can be. So I'm not here to provide you with all the answers. I don't have the magic bullet approach, but what I want to do at the very least is provide you with a sense of clarity, something get you to a point where you have some proper perspective, and really just get you a position where you can at least make the right decision for yourself. So that's priority number one at the start and at all stages throughout, basically. In terms of the service is intended to provide an investment alternative that is, with maximum stability. And that's what this all really comes down to. So if you take anything away from this presentation, this session here, make sure it's those two things there. We want to give you a sense of clarity in a very low clarity industry, and we're trying to offer a service here and an investment alternative that has maximum stability. Now, stability is a key word there, and it's going to be very much the focus concept throughout this session there. So stability is a little bit more nuanced than simply safety. So safety, defensiveness are big focuses as well, but more specifically, a more specific aspect of safety, at least once again for the focus of this session, is this concept of stability. So that's what we want to provide, and now we want to think about how that is actually achieved, because of course stability and transparency and clarity and peace of mind and all these things are lovely words, but let's talk about how they're actually achieved. Well, two sides of the coin there. Number one, we want to offer a combined strategy service. Okay, so you've got combined strategies running or operating within a single account service. You don't need to do multiple allocations or spread money all over the place. You just have a single account, and then within that account we have a diversified approach across multiple strategies. So the strategies run across different markets. They run in according to different approaches. They're actually philosophically different, which for the more experienced amongst you, you'll understand the difference between mean reversion or contrarian type approaches and the simple trend following or trend capture type approaches. We want to try to combine multiple philosophies, multiple strategies, so you get proper diversification, true diversification, rather than just spreading your capital across different sectors of different markets and so on and so forth. So that's how that works, but it all happens within a single account. So as simple as you can possibly hope for, effectively. And we do want to take advantage of both rising and falling markets. We don't want to be dependent upon things being all rosy and positive forever. We want to be able to adapt, and we don't want to be, again, over vulnerable or essentially over reliant or dependent upon positive market conditions forever. And sometimes that's as simple as simply staying out, simply sitting on the sidelines and waiting for clarity to improve and things to look a little bit better. Simple as that, really. And as I touched upon earlier, we want to look for growth where it actually exists. This is a bottom-up, or again, a first principles type approach. We want to look for growth opportunities, that is, where they exist, and not just where we want them to be, not to be overly narrow in our focus, and then naturally try to adapt accordingly. So that's what we do. Now, very much in line with everything else I've sort of touched upon thus far, it's also equally, if not more important, to understand what we don't do, what we want to stay away from. So we certainly want to stay away from engaging in any high frequency trading, HFT that is, / any high risk or unsustainable ultimately, or any sort of exotic novelty type methods there. So some of these things do all right, as some of you know. The downside, which is a crucially large downside, is that none of these things are really sustainable. They're unsustainable. They might do all right for a while, and then you wake up one day and it's all of a sudden not looking so good anymore. So we don't want to do that, both principally and philosophically and strategically. We want to invest in strategies and approaches that are time tested and are not going to fall apart as soon as some politician does something, or as soon as the world takes a bit of a turn, which is going to happen, as we all know. We don't want to rely upon a buy-only / always in the market approach, and we're going to talk about that in some real detail. We want to be adaptive as we can, and very much in line with that, once again, is we don't want to be overly reliant upon any particular set of market conditions or circumstances or market type. Again, it's a first principles approach. You look for opportunity where it is, and if you can manage the risk accordingly, and there's a reasonable expectation of growth, profitability, reward, then that constitutes an opportunity that's going to fit within the overall service and strategy criteria in combination. Now, all of that is quite complex, I understand. One of the challenges I have is that a lot of our clients are really very experienced in the industry and experienced in the in the markets, and then on the other side of the spectrum, the other end of the spectrum, we have a lot of clients that are just complete newbies. Okay, so do reach out for additional clarification. I want to try to sort of help everybody out as much as I can, but to perhaps try to simplify the focus there, I encourage you to really, irrespective of your experience level, is to focus upon a couple of simple questions there. Questions to ask yourself and questions to keep in mind throughout. So the questions are, how much medium, perhaps long term, but at least medium term confidence do you have in the local / global share market or share markets? Okay, so it's phrased intentionally there because these are highly correlated markets. We're all effectively dependent upon, or subject to, I should say, global forces, very large scale, top down type forces. So that's question number one. And question number two to keep in mind, to bear in mind, is, do you think or feel perhaps that you'd benefit from some true diversification, very largely avoiding market instability, with the potential on top for healthy returns? So that question there is also phrased very intentionally. So we can't promise returns. You can't promise profits. No one can, because no one can predict the future with certainty. And you've got to be very careful of the people that do. Some of you know this very well already. But due to the structure of the service and the approach that we're going to be talking about a lot as we go through, we can avoid market instability as an absolute minimum. Okay, so I want everybody to really keep that in mind, and again, ask yourself if you think and perhaps even think logically in terms of the financial benefit, and feel in terms of the peace of mind, avoiding sleepless nights and worry and all the rest, that you'd benefit from some real diversification, again, with the potential for some healthy returns, or even some very healthy returns, or very, very high returns, potentially. So let's explore that a little bit further. And we want to take a problem / solution approach, or a problem plus solution approach, I should say. So the approach of the vast majority of the population is pretty straightforward and pretty uniform. Speaking about us as a species, as a community, as a population, we're all kind of doing things the same way. Again, just looking at the general public, the general population, it's the very long-term buy and hold approach. So there's very good reasons for this. Sometimes one of the things to be clear about is there's actually nothing inherently wrong with this. It's actually an effective approach. It certainly has its positives, but there's some very good reasons why people do it, beyond the simple benefits. And the reasons, of course, are that people have superannuation funds, involuntary contribution funds. They work, and a portion of their time and energy that they spend each week just goes into these funds that just employ this very long-term buy and hold type approach. The other thing is that over time it does tend to work out, but the key criteria there, the key phrase there is over time, and that's where we hear this phrase very often repeated in the industry and around the internet, which is that it's all about time in the market and it's not about timing the market. So it's one of these catchphrases, it's one of these slogans. Again, there's a lot of truth to it. It's not inherently wrong. It's just another one of these slogans that are kind of overused and abused, you might say, in the very least that the people that tend to abuse it the most are the ones that don't focus upon the downsides of this type of approach, or what's lacking from this type of approach, is what we should say. So let's explore that further. Now that's one chart, and I'm just going to switch over to another one here. So what we see here on the chart is long-term equity index portfolios for 6 of the major markets around the world. 3 of them are US, so that's the Dow Jones, the Nasdaq, the S&P 500, and we also see there in yellow down the bottom, just alongside the green one, we see the Australia 200, okay, so the ASX 200, the S&P 200, alongside the green one there, which is the FTSE, the UK index, the UK 100. Okay, so thinking about this long-term buy and hold approach, its benefits are that it's very simple, and that over time, of course, you probably are going to do okay, but it's lacking in some areas, and one of them is the lack of diversification, as we can see there, and as we saw on the previous image there that I'm going to talk about in more depth, amongst other things. Markets do very much move in the same way over time, so there's some discrepancies and some variations between the amounts or the percentages by which they move, but the overall direction is very much uniform over time. There's a very high degree of correlation over time, even if there's a difference in the percentage movements, as we can see there. And there are reasons for this. Globalization is a big factor, of course. The relatively uniform central bank policies around the world are very much a factor of this, especially prevalent over the last 10 years or so, especially following the GFC, when everyone's just sort of started printing money all over the place, quantitative easing, as they call it. The global financial system as a whole is just becoming more and more interconnected, as we as a species, in more ways than one, are more and more so interconnected. Now that's good in some ways, but it has its downsides. Now the other challenge, of course, when you're employing this very long-term buy and hold approach, time in the market versus time in the market type approach, is that, well, number one, you don't know which market to allocate your capital to. So the majority of people, just by default, are going to sort of just take what's given to them effectively. So and I've been through this very early in my career. You get a job, and they set up a superannuation fund for you, and a percentage of your time and energy, your work week, gets taken out and put into that thing, and you don't really know what's going on. It's all just sort of spread across the market, and by default, it's spread across this thing called the ASX 200, effectively. Now, you can make some more discerning choices if you wish, but the question then becomes, which market would you then allocate your funds to if you're just looking to follow this long-term buy and hold, time in the market type approach. Now the temptation, of course, which is a natural temptation, very natural temptation, is to just jump on the one that's doing the best. Okay, so in this case we can see that the Nasdaq 100, the US tech stocks, your Googles, your Amazons, your Facebooks, your Microsofts, your Netflix, and 90 odd others have done the best over this 10 plus year period that we see there. But remember that you're following this approach, you're making a very long-term commitment, something like a 5-year commitment at the minimum, perhaps more like a 10 or even more term commitment. So when doing that, you need to take a bit more of a broader perspective. And so when we do that, when we zoom out a little bit further, you see here that the situation actually starts to change a little bit. So we can see here that yes, the Nasdaq has been the best performer since say 2014 or 15, let's say. But prior to that, and in fact from 2008 back several years, it was actually underperforming all of the other markets. Now, if we zoom back a little bit further, at that point, of course, Australia was outperforming there, the one in yellow. And if we zoom out a little bit further, the perspective, the overall picture, looks even different again. So now, just bear in mind that the only reason markets go up is because there are more buyers than sellers. And so when we look at the Nasdaq, for example, when we saw this huge run there from 98 all the way up to the early 2000, the reason it had that is because the general public were just rushing into it. It was a gold rush of sorts around technology companies, and again, the same companies, your Apples, your Amazons, and so forth. And at that time, a lot more smaller ones that are gone now completely, of course. But it went up because the general public, as they do, getting in late stage in the game, rushed into things before the hedge funds and the big managed funds, the big players around the world, all started selling off. And then, of course, there wasn't just this big crash that brought down other markets, but the years following this, as we can see here, weren't exactly that great for the people that bought in 97, 98, and preceding years. So when we look at the Nasdaq here, there's actually a period from April 2000 all the way up to effectively October 2016. So nearly 17 years there, where these Nasdaq investors weren't really that happy with the way things were going. Okay, so there's other considerations, of course. There are dividend payments, and there's the fact that you could have bought more as the market went down, and so forth, and all of those are valid considerations. The dividends, however, with the Nasdaq, since we're just picking on the Nasdaq for the moment, are very low in the Nasdaq. These tech companies are growth companies. They reinvest their profits internally rather than distributing them to investors, generally speaking. But anyway, bottom line, so to speak, is that there was this 16 or 15 odd year period where investors were still in the red. They were still underwater, effectively. Now the same goes for, we can take other examples. We can look at the Australian market, which is still below its pre-GFC highs. And if we want to take a really extreme example, then we would look at the Japanese market. So you can see here that Japanese market here, the Nikkei 225, that is the blue one, tracking along here. So very much correlated with other major markets, at least over this sort of 10-year period. But if we were to separate it so that we can look at it in its own right, we can actually see here that it's still sitting below its 1990, February 1990 highs. Again, this excludes dividends, so that's not a prediction. That's not saying that the Nikkei, for example, if we're talking about the Nikkei, isn't a good investment right now. Perhaps it is. That's an entire other discussion. I really just wanted to give people some perspective when considering or again being overly reliant upon this long-term buy and hold approach in the expectation, the belief, this oft-touted conventional quote-unquote wisdom that stocks always go up and you just have to be patient and so forth. Well, yes, that's actually a very valid approach, but it's not the magic bullet, and you've got to consider other possibilities and consider the fact that we could well be in an environment where stocks are going to be below their highs or be in less than ideal conditions for several years perhaps. Okay, so that's that. And jumping on the Australian market to talk about that, another thing that I've talked about at length in the past. Nothing I'm talking about right now, by the way, is new. I've been saying the same thing for many years, well before crises, or this crisis or that crisis or anything like that. So I'm not trying to, jump on the bandwagon as such, but talking about the Australian market more specifically, it's another myth that we are somehow invested or dependent upon the success of local companies and how fantastic their board of directors are and how good they are at doing this and that and the other. A big mistake that Australian investors, everyday investors make, for example, is to be over-reliant upon the banks. So we love to quote-unquote support local businesses and support local companies, invest in things that give us this illusion of safety through familiarity. I'm going to repeat that. This illusion of safety through familiarity. We like to we go down and pay our bills at the local bank or do whatever we want to do, and we therefore somehow equate that makes it a good investment, because again, that sense of familiarity. The banks in the Australian market are not just massively overweight. We're in developed markets. We're quite substantially the most overweight in the financial sector than others, more so than the UK, more so than the US. The financials make up some 40%, 30 to 40%, just in and of themselves. The big four banks make up some 20% of the overall market, and then we also have to take into consideration the fact that these companies are not just massive and overweight in and of themselves, but of course they're also massively influential. These are the ones that control the credit supply, control the money flows, very much influential when it comes to monetary policy and even political policy. Their effect and overall dominance can't be overstated. And the point I'm trying to get at here is that the mistake that we make, generally speaking, people, is that they think that they're investing in Australian banks. Well, I'm here to tell you that you're not. Your future, if you invest in these banks, is not going to be determined by what the Commonwealth Bank Board of Directors does tomorrow, or what the Westpac CEO or Board of Directors does the following month. You can see on the chart there, we have, I realise it's hard to see, but what we have there is the big four Aussie banks, okay, and then we have big four, or four big US banks, okay, so Goldman Sachs, JP Morgan, Wells Fargo and Bank of America. And the reason why you can't tell them apart is because they're not effectively operating independently or effectively in any real sense controlling their own destiny. They're all just part of this tide, part of this wave, part of this ebb and flow that we're all subject to at the end of the day there. So again, just like everything else, there's discrepancies or differentials in the amount or percentage by which they fluctuate on a day-to-day, week-to-week, month-to-month, year-to-year type basis, but really they're all just going in the same direction again, because they're just governed by the same forces. On a bit of a side note there, Goldman Sachs and JP Morgan own big percentages of NAB and ANZ and others in any case. Zooming in a little bit further there, that's the same chart, just zoomed in a bit. And the key point of focus there is that there's not just this massive correlation, but when crises hit, when fear takes over, that's when you really see the correlation. So if you look to the left of the chart there and look at the decline there, again, these are 8 different major banks on literally opposite sides of the world, and they all just sold off in an extremely uniform manner. And there's just no getting around that fact. And I promise you that I'm not cherry picking. You can jump on the charts yourself and do your correlation overlays. You can put Royal Bank of Scotland in there, Lloyds, HSBC, Deutsche Bank to a lesser extent. The German banks are a little bit anomalous, but most of the Western banks essentially all follow this extremely uniform pattern. And again, especially when we're presented or experience times of crisis. So really harping on about the buy and hold type approach there. There's dividends to take into consideration, of course, and there's also inflation to take into consideration. And I don't want to focus on inflation too much because it's an entire other conversation. It's a great big rabbit hole, but it is an important consideration nonetheless, and it's going to, in all likelihood, continue to be more of a important consideration as global banks all around the world just continue to pump money, or print money I should say, out of thin air like there's no tomorrow. But that's an old chart there going all the way back to 1900, and it just compares the price or sort of apparent returns of the US stock market versus the adjusted or real money type returns there when you account for inflation. All right, so where do we end up when we start carrying on about all these things? Well, quite a bit to take into consideration, as you can imagine. And one of the key points is that, of course, the past is the past. And while we can learn from the past, as we should, it goes without saying almost that the future is what really matters. And so, despite everything I've just said, I'm not here to predict the future for you when it comes to the major global equity markets. So there's a sort of semantics involved there, but we when you really get down to it, we want to try to avoid making predictions in the strict definition of the word. We're going to take a look at some charts in a moment, but it's very important to understand that crystal balls are for fools and charlatans. A lot of you know this already, but it's something that really does bear frequent reminding, I suppose. What we're really trying to do, and when I say we, I mean any any investor, money manager, professional, whatever you want to call it, private trader / investor, whatever you want to call it, doesn't really matter. If they're serious about what they're doing, they understand the fact that what's really required is an objective assessment of the probability. So Warren Buffett's, your Ray Dalio's, it doesn't matter whether you're a long-term investor, a short-term trader, a commodities trader, an options trader, a mining speculator, or whatever the case may be. What you're really trying to get good at is assessing the probabilities of scenarios playing out, scenarios occurring, and subsequently allocating capital / risk appropriately. And this is what really matters. You assess the probabilities and you allocate capital / risk according to your objectively assessed probabilities. That's what it all comes down to, ladies and gentlemen. So I don't mean to insult anyone. You all know that there are crystal balls, but there are a lot of purported techniques and magic potions and all this other sort of stuff that I'm continuously seeing floating around the internet. A lot of my clients are older, and they know this very, very well. But there's a sort of a new breed of trader slash investor slash spruiker that's popping up all over the place with the ever increasing prevalence of the internet and social media and all the rest. And it's painful to see, because I know the way these things always turn out. But anyway, I'm carrying on a little bit there and getting digressed. So despite all the complexities and uncertainties and all the rest, we can actually simplify things, at least to some degree, in the approach and the prognosis, if you like, in understanding that there really are only three primary market conditions. So broadly up, broadly down, and broadly sideways. So that's what it really all comes down to, especially when we're trying to make this probability assessment and this capital allocation assessment, especially once again, as I say, when it comes to the long-term buy and hold passive type approach, excessively, you might say, or exceedingly passive type approach. And so let's have a look at that, because I do want to, despite everything that I've said about crystal balls and all the rest, I do actually want to give some perspective as I can. So now, here we're looking at the S&P 500. Now, when it comes to looking at or trying to assess the outlook for the global markets, and as we've seen, they're exceedingly correlated. When it comes to trying to determine a direction for the global markets overall, the best one to look at is the S&P 500. So it's the top 500 companies on the US market. These are the ones that really determine our fate around the world to a very real degree, and as distinct from something like the Nasdaq, for example, or the Dow Jones. It gives a much broader perspective, being 500 companies as opposed to 30 or 100, and it's much more cross-sectional or intersectional in that there's tech companies in there as well as banks and a bunch of others, of course. So focusing on that one for now, what we can see here, of course, is that considering the buy and hold approach, yes, over time, it does tend to follow this long-term direction there, despite 10-year periods and 15-year periods of and so on. Over the long term, it does work itself out. Now there are reasons for this, of course. These companies and these specialists and the engineers and the people that innovate and create new technologies, eventually they figure things out. So they figure out new ways to adapt to changing conditions and adapt to competition, and effectively they continually figure out new ways to keep their companies profitable. So that's a very key point to understand, because I don't want to sound like I'm bashing the long-term buy and hold approach too much. But the other thing that we see here is that despite this long-term direction, as the price continually expands, as we can see here, the ranges expand accordingly. The ranges get wider. Now that's a very important thing to understand when it comes to the decision of how and when to allocate capital, how to actually invest capital, because they're not just expanding in percentage terms. So as we can see here, if we look at this sort of range here, one moment, just adjust that one there. if we look at the range here, we're looking at a 17% range from peak to trough, bottom to top, and being a little bit more accurate there, it's not just a 17% or 18% approximately, let's say, range, but it's actually 25 months. So it's 2 years. Now, as companies continue to take on debt, and as inflation increases and all other kinds of things around the world occur, inherent risks increase and political tensions increase and so forth, we don't just see the percentages increase, as we can see here, looking at the one we experienced more recently, this 35%, 36% or so type very fast drop. It was more than 35% on other markets, including the Australian market, because of the banks, mind you. But it's not just the percentage that increases, but it's also the time that increases. The time span increases as we look to see these ranges ever widening. So now, what that means when you consider the investment capital allocation question, is that we may have some really quite serious protracted ranges, as we can see here. So I'm going to give you a bit of a drastic type scenario, again, just for perspective. You want to sort of consider the extremes and then work within that accordingly. But as we can see here, as opposed to the previous consolidation type range that we saw there, and even ignoring the previous ones, we now see a 40% range, as you can see here, and it's 89 months. So we're actually extending or projecting all the way out to May 2025. So a good 4.5 years away. So it needs to be taken into consideration. Now, again, in an attempt to simplify things, as we should as much as we can. There's a famous Einstein quote, which is that things should be simplified as much as possible, but no more so than that. So you try to boil things down to not overcomplicate them, but you also don't want to oversimplify them either. Easier said than done, of course. But anyway, we do have the generally three types of broad market conditions: broadly down, broadly up, and broadly sideways, as you can see here. Now, it comes to assessing the probabilities. For me, the probability and the subsequent risk to reward considerations lies in the sideways type scenario there. So there's of course there's potential for further upside, where we're coming to the point now where we've got some realistic considerations or hopes, at least for the vaccine. A number of companies have come out and made some pretty impressive promises. At least central banks are going to, in all likelihood, continue to, at the very least, support the markets. There's a question as to how much money they're going to continue to pump in, and how practical and how feasible that really is. But I think at the very least they're going to continue at least support the market, which means that I don't think there's going to be any major crashes in the short term. But again, we've got to consider that at these extreme ranges that we're at, these extreme levels, I should say, even a little retracement to the middle of the range here is a 25% move. It's a 25% range. So even looking with some more conservative, moderate type calculations and projections there, you're still looking at 25% if it just comes down to the mid-range and tries to normalize a little bit, plus an additional, say, 36 months or so, where we're up to extending up to the end of 2023. So that's excluding the disaster type scenario. I don't want to be a doomsdayer, and I don't want to. I certainly don't want to act like I can predict crashes and black swan events before they happen. That's not what they are by nature. But again, I'm just trying to lay out some scenarios for you and look at not just the probabilities, but the risk-reward considerations relative to the probabilities, which is really what it all comes down to. So now that's that, and let's consider some additional things here. So most people just want safe and reasonable returns, but there are additional considerations to take into account. It's a very fair and reasonable expectation, I understand, but we have to consider everything. And so I'm going to jump across now to one final chart for now, and we've got another one later. And this brings up sort of the second key point that I want to make on the idea or the concept of buy and hold, long-term buy and hold. So what we see here, I'm just going to adjust this a little bit. What we see here is, again, the S&P 500, top 500 US stocks, an aggregate of them, an index of them as it is. And we see it's actually not that one, and you'll there we are. The ASX 200 there in goldish orange there. So again, doesn't need to be repeated too often, but massive correlation long term. Now, here's the thing. If you just want to take the buy and hold approach, the ultra patient buy and hold approach, and a few years worth of volatility and or perhaps potentially many years of volatility to low to negative growth. US markets have gone through entire 10-year periods where there was effectively zero growth, by the way, but I won't distract myself too much again. The real point that I'm trying to make here is that if you do want to take this approach, there's nothing wrong with it if it fits within your plan and your priorities and the stage of life you're at. The key point that I want to make, once again, and I will get to it eventually, is that you don't need a fund manager to do this. You don't need a financial advisor, you don't need an educator, you don't need a signal provider, you don't need a money manager, you don't need anything. All you need to do is get out there and buy an ETF that mirrors the performance of the overall market, and then you sit back and you check on it every 6 months, 12 months, 18 months, 72 months, I don't know. But that is as simple as it needs to be, as complex as it needs to be, I should say, when it comes to this ultra patient long-term buy and hold approach. Now I'll try to make it as convincing for you as possible here. And again, you don't need me to do this. You don't need anyone to do this. So we're going to look at the it's a index fund, which is basically just a stock, right? It's a share. So you jump on your ComSec or your NAB trade or whatever it is, and you go and buy STW, and then you get what is effectively the exact performance of the ASX 200, as you can see here. And if you can't see it, that's because it is very, very, not by fluke, but actually designed to almost exactly mirror, track the performance of the ASX 200. Okay, or if you want to do that in the US market, then you can do that too. And again, it's hard to see because by design, all it does is it just, you probably can't even see that one there, or maybe you can. The yellow line there is distinct from the grey one. All it's designed to do is just exactly track the performance of the S&P 500, the US market. So that's it. So if you do need a hand with this, you give me a call. I won't charge you a cent. You can just go and buy STW, or in this case IVV, on the US markets, and sit back and relax. Wait 10 years, 5 years, and in all probability, you're going to do okay. In fact, there's a chance, if you do have the time horizon, once again, you're going to, the chances favour that you're going to do pretty well. Okay? But you don't need anyone to help you with this. Maybe just someone to click a few buttons for you, or tell you what buttons to click, but I assure you it's incredibly simple. That's all you need to do. So, getting back to the key points that I tried to emphasize, the two key questions. The question really is, do you want an alternative, or do you want something that you can actually diversify into that's going to give you something different, some actual diversification that isn't just following the markets? And I'll show you one more. In fact, there's this one here, this purple one that you see here, this monster looking thing, is a leveraged version of the yellow one. So I'll get rid of the S&P 500, so you can just see the yellow one, and I'll get rid of Australia, so you can just see the two side by side. Okay, so the purple one there is the exact same version, the exact same strategy, philosophy, whatever it is. Whatever money is put into this exchange traded fund, whatever's bought, that exact amount of money goes into the top 500 stocks on the US market. Now the purple one, distinct from the yellow one, does it at double leverage. Okay, so it's the exact same thing, the exact same approach, except it's double the leverage. Okay, or double leverage, 2 times leverage, 2x leverage. So very, very key in consideration of all these things, and we're going to talk about this in more detail as we go through, but very, very key here is that all returns need to be considered relative to risk. So you can see here that the purple one, of course, being leveraged, has delivered a lot more profit over time, but it's also been extremely volatile. So in other words, it's provided more volatility risk. Okay, so I'll just say that again. Volatility risk as distinct and separate from structural risk or operational risk. Okay, because it's the same companies, it's the same 500 companies. So it actually has the same underlying operational or structural risk, but it has double the volatility risk. Okay, so that's getting a little bit advanced, but I guess it's worth bringing up nonetheless. So the key point there is that all returns should be considered in risk relative terms. Okay, it's great to say you generated 500% performance, but a true professional is going to ask you, what kind of risk did you take in order to determine that? Because that's how we actually assess the sustainability of anything, any opportunity. Okay, getting back to things there. Yeah. So considerations, really just sort of summing it up there, or trying to at least. Global equities are highly volatile, and the probability, in my opinion, my perspective, my outlook, is that they are going to continue to be so for several years. I don't think we can get away from this fact. I think it's really quite clear. Significant exogenous risk factors are still in play. Exogenous just means external risk factors, not necessarily economic. So an exogenous risk factor might be a war, political tensions, social upheaval, social tensions, or things like a disease, a virus, pandemic, so on and so on, or more pertinent, I would say, is the fallout effects, the knock-on effects of things like this. Moving on, the global economy is subsequently highly uncertain, and bank interest rates are historically low. So, none of these things are really good in and of themselves on their own, but in combination, it's, well, you don't need me to tell you, really. Overall peace of mind, not just in terms of the market, but in the investment community, overall peace of mind is really low. And ultimately it just is very hard to know in this kind of environment which kind of quote-unquote wisdom to rely upon. Okay, so we've been, a lot of the things that we've been told are safe and wise and conservative. Well, over the last couple of years, or certainly over the last 12 months or less, it's not really playing out that well. When the rubber meets the road, so to speak. So it's hard to know which kind of wisdom to rely upon, which of course just adds to the overall challenge of the situation. So really that's what it's all about. We want to provide an alternative to these things, an alternative with maximum stability. I can't promise sky-high profits, or I can't promise a magic bullet, magic potion type approach. I certainly don't have a crystal ball, but I can assure you of stability. That's something that this entire venture has been designed around effectively. And more so than anything else, I just really want to give people a sense of clarity first and foremost. So now, let's talk about some of the actual components of that. So when considering these things and looking at the MSP service, the Managed Strategy Portfolio, consider it in 4 different components. There's security, which we've touched upon, flexibility, which we'll get to, profitability, and the overall philosophy. So we don't have time to go into full depth with these things in this session. We'll touch on a bit of it, and I'll give you some links so you can go and explore things in more depth yourself. So, all of these things, as complex as they may sound, come down to a couple of very crucial core principles. Ultimately, what you're trying to do is you're trying to invest in a system with what's known as a positive expectancy, a positive statistical edge, as the fancy industry term is. Now, all that means really is that when you average out all your profits and average out all your losses, you have a reasonable and logical and numeric, rationale-based expectation of continued profit according to the nature of the system. Now, system could mean a strategy, or to give a more common example, if you were to invest in a company, if you were to go and buy BHP or Google or Microsoft or whatever it is, you're actually investing in a system that has that positive expectancy, or that positive expectation of continued profitability. So system is a very, very broad term, but irrespective of long-term, short-term, up, down, American market, Japanese market, it doesn't matter. Commodities, warrants, futures, options, it doesn't matter. Everything comes down to this idea of positive expectancy. You can't get away from it. It's a mathematical truth. It's a law of the universe. I can't stress that enough, even though I do sometimes. Too much, perhaps. But now, once you've got that positive expectancy system, you need to understand that it's still just an ideal type scenario. It's still really just as close as we can possibly hope to getting to the Holy Grail. All right, we're never going to get the Holy Grail, but a positive expectancy system is as close as we're possibly going to get. But it's still just a rationale and reason-based expectation, and not a guarantee. And so then the second component, which is in fact more important, is to ensure that you have the downside protected with maximum precision. Now, there are additional components to that second aspect, which we're going to explore a little bit more. It includes, as touched upon previously, be prepared to sit on the sidelines. You don't need to be in things just for the sake of it. Focus upon the world's largest markets. Largest markets means the maximum amount of, or much larger amounts of buyers and sellers, meaning that it's easier to get into at good prices, but much more importantly, it's easier to get out of at a reasonable price, a good price, if things turn around. Incredibly important, that liquidity aspect there, found in the world's largest markets once again. And that really is just the nature of the game, which has to be considered once again in two key aspects there, which is the attack side of things, achieving growth, finding profitable opportunities, generating returns, and so forth, and of course the defense side of things, capital preservation and capital protection. Now, it does simplifying things, which you shouldn't do too much, but simplifying things, it does come down to those two categories. Now, the problem is that most people put too much emphasis upon the attack side of things. It's what we are by nature. Different personality types vary, of course, but many of us get excited about things and we sort of just want to charge in and grab the money and take advantage. Where in actual fact, the people that do well over time, the people that actually do get the big profits over time, are the ones that do take this defense first approach. Defense first, defensiveness first, capital preservation and capital protection measures first. And it all just comes down to looking at things from a broader perspective rather than an individual and specific perspective. So you're in a battle, you're going to lose soldiers, but you want to make sure you don't lose so many soldiers that you end up losing the war. So you can lose a battle, but you want to make sure that you don't take such extensive damage that you end up being in a position where you can no longer fight the war. All right. So now let's explore that a little bit further, because, and I almost hate to harp on about it, but it really does need to be understood. So again, when you get out there and start browsing around internet and Facebook and listening to all these gurus and everyone else, you don't very often hear the defense first approach. It's all about, I made 10% profit on this stock and so on and so forth. So it's not just a reflection of human nature, but it's very much a reflection of the industry. But the principles operate outside the industry and beyond the industry. The quote there is that offense sells tickets, even though it's actually defense that wins championships. So it's actually a bit of a mentality shift. You need to learn to associate profits, rewards, gains with the defense first approach. It's actually this defense first mentality that's going to get you the big dollars, if you want to put it that way. All right. So that's actually a sporting quote there. Bear Bryant was, I should say, an NFL coach, American football coach. But it is statistically true. I didn't even immediately believe it myself, but I looked it up and it's actually true. The most successful long-term sporting teams, the one that win the most championships, are the ones that have the best defense. Not always, but overall. And this mentality, as we've been reminded of in 2020 in stark terms, does need to be applied to that is the markets, because in the markets we have these things termed as black swan events. So we can have our defenses up and we can be careful and we can look at certain things and etc. But a black swan type event is not just something that's highly damaging, but it's actually unpredictable. Okay, so not hard to predict, it's actually unpredictable. It's actually, to truly qualify for the term black swan, it needs to be not just an unknown, but an unknown unknown, or an unknowable unknown. So there are actually things called grey swans, which is a known unknown, a known risk. A black swan event is an unknown risk, something that really comes out left of centre and causes turmoil. So we need to be considerate of these things, to say the least, and looking at risk as a general concept there. It's another one of these things, like risk, profit, safety, and so forth, that should actually be explored a little bit further and separated into sort of more nuanced categories. Because risk, just a simple risk is not risk. Not all risk is risk. You actually should consider it in two aspects, which is likelihood or probability, and impact. So basically, how likely something is to occur and what kind of impact it would have if it does occur. Now, the exact same thing can be said of profit, by the way. Profit or gain or reward or return. You consider in how likely it is and how much it would actually benefit you. But for now, we're focusing on risk, and for good reasons. Now, all right, I want to talk about this in a bit of detail here. So when we look at systems, results, strategies, approaches, one of the ways in which we can measure it is through what's called a statistical distribution. So that sounds very fancy. It's not really, and I'll do my best to sort of illustrate it as I can. But it really all comes down to, again, this idea of the mentality shift, and that defense is what creates not just greater stability, but actually puts you in the position to generate greater returns over time. Okay? Now, I've done lots of different psychology sessions and so forth, and I can, for clients it is, I can tell you that this is the problem that people have, is that they don't commit enough energy to the defense side of things because they're not excited by it. So they commit their personal resources, internal resources, emotional, intellectual resources to this idea of chasing profits, profit generation, profit. Now, if they were actually able to switch their mentalities there, they would actually achieve what it is they're really after in the first place, okay? Because it is the defense first approach that is going to get you the profit, okay? Anyway, statistical distribution there, it's the bell curve basically, and we'll look at this one here. Basically, all that you see on screen at the moment is a random, okay, I need to emphasize that, it's a random distribution of the results over time of a particular strategy, a particular system, or whatever it is. It's just a random one. You can think of it as a dice roll or a coin flip, as you please. So the bell curve idea is pretty simple. Basically, anything to the left of center, and the further you go from the left of center is bad. It's a loss. It's a cost. And anything to the right of center, and the further you go to the right, is a benefit. It's a profit. It's a gain. And then the vertical aspect there measures how often it occurs. So the further up the hill there, the more often it occurs. The further to the left or the right, the higher impact it is. All right. So now, when we consider our approach, when we consider strategy development or capital allocation or whatever it is, we need to again always approach things with the mentality that there are not just known risks, but there are unknown risks. There is always the potential for, at some point, perhaps even eventually, for something to take the world, to sort of knock the legs out from under the world. So we want to ensure first and foremost that we have protection measures in place to ensure that, well, realistically, not just if, but at least eventually when this occurs, it's not going to impact us. Okay, we can be protected. There are ways to do this, as we've touched upon previously, and you can do this very effectively. You can. And the next consideration there is the heavy losses, the impactful losses, the ones that don't necessarily take you out of the game and destroy your portfolio, but they do have a very unpleasant effect, let's say, and those are statistically more likely to occur, even though they are lower impact, and they're at least as easy to protect yourself against. So you want to have protection measures in place for that. And then what this does is it just leaves you in this position where, just purely statistically, okay, remember, this is just a random distribution. This has nothing to do with picking the markets with a high degree of accuracy or anything like that. If you can just be disciplined and structured and diligent in your approach, then you can leave yourself in this healthy area over here to mostly the right and then slightly left of center. Slightly left of center means that you're still going to take losses. You're still going to incur trades that don't go according to expectation, and politicians are going to do silly things and they're going to spin the markets around a little bit from time to time. You're still going to take losses, but you never take anything that's exceedingly damaging, or really anything that's outside of the realm of acceptability. So you have a defined amount of loss, and you take measures, put measures in place so that even if things go badly, it's still within the realm of acceptable loss. And then, as the law of averages, the laws of statistics, the laws of the universe of mathematics play out over time, you just end up in a position where your results on an individual buy/sell basis is a small to medium gain, a break even, small loss, or occasionally, at least, you get the large gains and the meaningful winners. Now, what should be conspicuous by absence there, I hope by now at least, is that you don't take the heavy losses, and you certainly want to make sure that you're protected against the catastrophic losses when the next black swan decides to swoop down upon us all. Okay, so I hope that makes some sense. Incredibly important, as I say. And so the next aspect there comes down to then maximizing flexibility. Now, this is something that's going to need a little bit more explanation, and so I'm going to do the best I can. It is a little bit more complex, and so I'm going to do the best I can, as I say. But it comes down to this fact: as much as we want to talk about conservative this, aggressive this, high risk this, safe that, and so on and so forth, at the end of the day, these are all subjective terms. It might be aggressive for you, it might be high risk for you, it might be very low risk for someone else, it might be somewhere in between. It really all just comes down to where you're at in your life, how easily you can sleep at night, how much of your portfolio you're allocating to any particular opportunity. They're all very, very individual, and everything needs to be considered accordingly, including the oft-touted long-term buy and hold approach, the ultra-patient approach. Everything needs to be considered according to individual circumstances. That can't be stressed enough. So the solution to the challenge of the the individual requirements, nature of the beast, so to speak, is just to maximize the flexibility of it. It's just to allow it to be personalized and tailored according to where the client is at this point in time, and where they might be in 6 months' time or 18 months' time, and how their preferences and requirements and levels of confidence change, and how market conditions change, and everything like that. So let's talk about that. And the way to do it is with this thing called leverage. Now, as soon as we start talking about leverage, everybody gets ready to run for the door, and they think that we're leveraging to the hilt, and we're going to cause the next GFC, and all of this sort of stuff. Let me try to simplify things for you and put them into some perspective here. Leverage, really, all it means is having the ability to take an investment larger than your cash balance, if you want to, and that's the key. So it's another tool in your disposal, and I can assure you that it's used by safe, conservative, many long-term investors all over the world, including Mr. Warren Buffett himself, who is perhaps most famous for not just the long-term approach, but the defense first approach. So it's not as simple as much as people like to carry on about it. It's not as simple as leverage is the devil and leverage is going to destroy the world. I'll put it to you like this, and I'll ask you, what is safer, driving a car or riding a horse? Okay. All right, now, some things to consider there. So a horse at maximum speed might go 50 k's an hour, let's say 50 kilometers per hour. A car, on the other hand, let's say max speed, it does 250 kilometers per hour, right? So now if you go out there and drive your car at 250 kilometers an hour, and the road conditions change, or if it's a terrible road to begin with, then yes, you're going to get yourself into trouble. It's only a matter of time, and you're going to cause yourself some massive damage and others massive damage, much more so than you would do on a horse, okay? However, what if you just drove the car at the same speed as the horse? What if you just drove the car at 50 kilometers per hour? So you're driving a car at 50 kilometers per hour, and it's a very comfortable speed, needless to say. And the horse, on the other hand, is sprinting, right? You kind of see where I'm going with this? So if you come off the horse at 50 kilometers per hour, you're going to hurt yourself, and maybe the horse, a lot more so than if you crushed your car at 50 kilometers per hour. So not just are you going to cause yourself more damage at 50 kilometers per hour on the horse, but at 50 kilometers per hour, the horse is also more likely to fall or stumble than a car is to go off the road. Okay? So the question then becomes, really, is, what would you really prefer? Would you prefer to forego the additional potential and benefits of the car just because you're worried that you can't resist driving at 250 kilometers per hour? Okay? If you can resist the temptation to drive at 250 kilometers per hour, especially when the roads are wet, then the benefits lie in having that flexibility. Okay? So I'll make that point to really try to make it clear, because it's something that I'm constantly sort of battling against. Now, you don't need to use leverage if you don't need to, but all of these things need to be held in proper perspective, and the high risk nature of leverage needs to be understood for what it is. It's only high risk if you use it as such, and again, given the flexibility that it provides, you can actually use it to provide an additional aspect of safety through additional diversification and a couple of things there. So that's really important to understand, ladies and gentlemen, and I'm going to flip over to the final chart for this session to try to put this into additional perspective for you. Once again, in consideration of risk, not just in terms of impact or likelihood, but the combination thereof, and this other concept that I touched upon on one of the earlier charts, which is of operational risk or structural risk. So here we see Fortescue Metals, FMG, very well-known company on the ASX, needless to say, and we also see MIN, which is, as you can see there on the chart there, these are very highly related companies, very similar in nature, and as such we see a very high correlation between the two. Some, again, just like the other examples we've covered this evening, differences in percentage movements, but what you can tell from that is that they're effectively governed by the same exact, if not very similar, forces, underlying forces and overarching forces. So here's the question. In again, looking at these concepts of capital allocation and not really properly considering performance in risk relative terms, real risk relative terms. So we see here over this, it's a little bit more than 10 years, we'll say this 10-year period, the FMG, Fortescue, has delivered a 300, we'll call it a 320% return over that period. Now, over the exact same period, MIN has delivered a 640% return. All right, so double the return. Okay, 640% versus 320%. So the question is then, which one of these was a better investment over that, let's say, 10-year period? Okay, so that the immediate temptation, and such a high percentage of people are going to tell you that MIN was the better investment. But was it really? Was it really? How wise would you have been back 10 years ago allocating a sizable portion of your investment to MIN at the time? Right. So we have to consider things in risk relative terms, and we're going to explore what that really means, because it's not just about returns, it's about the risks that were taken in order to achieve those returns. So if you can't allocate risk sensibly and in consideration of this balance, then you shouldn't be allocating a large percentage of your portfolio. You should only be allocating a small percentage of your portfolio. So if you only allocate a small percentage of your portfolio, how much profit are you actually really making over X number of years? Okay? Hope that makes sense. But I also want to emphasize an additional point here. It's not just volatility risk, it's also operational or structural risk that we need to take into consideration. So you can see that there's double the return. That's very, very clear to see. Now, what if we consider the volatility risk? Okay, well, okay, so there's a 2-to-1 ratio, once again, remember that, 2-to-1. Is there less than half the volatility risk with FMG? Well, I'd say there is. I'd say there is less than a 2-to-1 ratio in the sort of swings that MIN has there compared to FMG. So FMG, quite arguably, when we look at the relative swings over time, is more stable. There's less volatility risk there. So that's number one. Number two, what about the operational risk? What about the actual underlying structural risk? So what this really comes down to is that you've got a 2-to-1 ratio there of return A versus return B. If FMG therefore has less than half of the risk, that is actually the better investment. Okay? So if there's a less than 2-to-1, less than half to one, in fact, 2-to-1 risk on FMG, that is actually the better investment. So now, structurally, considering the other aspect of the risk consideration, we can look at the market cap as a measure of the overall size of MIN, $6 billion odd dollars, 6 billion odd Australian dollars in market cap, whereas FMG, Fortescue, has some 10 times that, some 59, call it 60 billion in market cap. So 10 times the market cap for half the return. Okay? So what that means is that structurally or operationally, FMG was, I would say, much more than twice as operationally or structurally safe. So even though you've got half the return, you've got twice the safety. And so then there's two things to consider. What if you just bought more, you bought double the amount of FMG as opposed to MIN? So what if you bought 200,000? Let's just use simpler numbers. What if you just bought 20,000 FMG instead of 10,000 MIN? So now you get the same return, but with less risk. Understand? Very, very important to understand. It's something I constantly come across, and it's not just a leverage consideration. It's when we look at small cap miners versus large cap miners and so forth, and it has to be considered once again within the context of this correlation. Correlation is so important, ladies and gentlemen. And so that's that. And then another what if for you. What if you just bought FMG at 2 times leverage? So you just used a little bit of leverage to take a company that's structurally, let's say 10 times more structurally safe than MIN. So then you get less volatility risk overall. You get a lot more structural risk. You get this, and you get the same return, the same bottom line return, just by using a little bit of leverage. Make sense? I hope that makes sense. Please let me help you further if it doesn't. So that's the real point of leverage, and that's why we want to have it in as part of our arsenal, even if we sometimes don't use it at all, or at the most use it conservatively. Okay. So now how does that work in terms of investing in the Managed Strategy Portfolio Service, the MSP service? I'll try to do my best to illustrate this, but I'm going to try to give you a fairly simple conceptual illustration there. There's more details at the site there, IU.au/performance, and there's a more in-depth explanation of this flexibility/tailorability type concept there as well. But let me see what I can do. So we'll look at long-term performance of a strategy, and through the construction and the nature of it, again, we want to take this stability first approach. We want to make sure that we're not exposed to excessive swings or the potential to be blown out of the water completely the next time a politician does something silly or some black swan decides to swoop down upon us. So that default stability-focused approach is intended to give you a healthy return, a fairly stable, healthy return. So we're going to say 25%. Now, historically, it's more than that, but I want to give you a sort of moderate expectation, let's say. And now, two things you want to take into consideration if you're looking to invest a certain amount. It might be 100,000, it might be 10,000, or whatever the case may be. You want to look to say to yourself, how much am I of this investment am I prepared to risk on this particular thing, and what sort of swings am I prepared to tolerate? What sort of the fancy word is drawdown, by the way. But it's just a temporary drawdown. Is basically just a decrease in your account value, your investment value, drawdown. So that's what you want to take into consideration. And let's say there's a 10% decrease that may occur, let's say every 2 years. It's actually, let's say more like 3 years, or we'll say 2.5 years to try to make it accurate. So every 2.5 years, there's a drawdown of, say, 10%. Sorry for the terrible writing. Drawing, I should say. 10% drawdown. Can you tolerate that? Okay, so obviously relative to the way the equities have performed historically, and of course very recently, 10% is not a huge amount. That may be a huge amount to you. It may be a very low amount to you. So through the flexibility of the service, we can either increase or decrease this for you. So we simply gear it up a little bit, or we gear it down a little bit, all 100% according to your preference. Okay, so let's say, for example, and again, this is risk relative returns relative to risk. Let's say, for example, you weren't really overly thrilled with 25% returns and you wanted to target 50% returns. Okay, well then we're going to gear that up for you, and you're going to get the same performance, directionally at least, and the same strategy, same everything, except you're going to be targeting 50% returns, and instead of having to tolerate a 10% drawdown, you have to tolerate a 20% drawdown. Okay, nice and simple. Target twice the returns, you have to tolerate twice the volatility risk. Okay, simple as that. Now, conversely, if perhaps you have a large portfolio, perhaps you're extremely conservative, and perhaps you're at a certain stage in your life where you don't really need to target 25% returns, then by all means, you might be happy with half of that at, say, 12.5%. I'm drawing with my mouse, by the way, so sorry it's not that clear. Hope you can make it out at least. And so it's the exact same concept. You're going to see the exact same directional growth to adjusted risk relative extremes. So you don't get your 25%, you get your 12.5%, but you didn't have to tolerate a 10% swing. You only had to put up with a 5% swing. So putting up with a 5% swing, of course, especially within the context of the market environment we're in, the global economic collection of circumstances, not just now, but looking over the past 3 years and projecting into the years to come. Obviously, only having to tolerate a 5% or even 10% swing, downward swing, that is very good. It's very safe. It's very conservative. Again, they're relative terms, but you just adjust this according to what you want. Okay, so this is really important to understand. Okay, so we construct this strategy and this approach to be operationally and structurally as sound as possible and stability focused. And then, quite simply, you tell us whether you want a sort of a moderate default magnifier applied. So this is the default there at 25%. So with that, by the way, you'll be looking at risking about 1% on any particular investment. So position, terrible writing, I'm sorry. But let's say we take a position on gold or BHP or whatever it may be. You might be risking 1% of your total account on that if you're on the default risk level there, 25% target return, 10% volatility / drawdown / swing tolerance. Okay. Now that's something you can set at the start. Okay, so by default, everybody just goes on this level there. This is the default level. You would just simply request a higher multiplier. That's a 2x multiplier, of course, but you can have 3x or you can have 1.77x. You can have 1.33, 3.21, whatever you want. There's no limit theoretically. Whatever you want. And you set that at the start, and then you can also adjust that as things progress. So for example, a lot of people might like to start out on the default level of risk, right there, targeting the 25% return, risking 1% per trade, tolerating 10% drawdown every 2.5, 3 years or so. And then as they get more confident over time, they might be happy to increase that. So it's just a simple matter of giving me a call or sending me an email, and we can bump you up. So, right at that point, you'd be risking 2% risk. Writing's getting worse. 2% risk, and you're now exposed to a 20% tolerant drawdown tolerance, targeting double the annual returns there. This is annual returns, by the way. All of these figures are annual returns. Okay. So, messy writing. Coming to the end of the presentation, we've covered a lot this evening, but I hope that makes some sense. Stability first, and then so the thing doesn't blow up, and you have a smoother ride as possible, and then you just apply a multiple to that according to how quote unquote aggressive / quote unquote conservative you are. Okay. So focus on some simple questions just to sort of draw your attention back to the original sort of framing of all of this, and the two questions that I asked you to keep in mind throughout. Again, I know we've covered a lot, and again, depending upon where you are in your investment journey and your experience level and so forth, some of these things may make perfect sense to you, and some of them may be completely off the planet. I don't know, but to really try to boil it down, just ask yourself how much medium term, or perhaps better long term, confidence you have in the local global share markets, stock markets, equity markets. They're all incredibly correlated. and they're all essentially governed by the same overarching forces. So we do need to take that into consideration, even if you do choose to employ what is not inherently a bad approach of the long-term buy and hold, wait it out, be ultra patient. Not necessarily bad, it just needs to be considered in balance and in perspective of everything else. But that's the question you need to ask yourself. How much medium to long-term confidence do you have in these things? Especially, and I don't mean to press the point too much, but in light of everything that's occurred in recent months. And secondly, do you think and think logically and feel in terms of peace of mind, which has a real value, of course? Do you think or feel you'd benefit from some true diversification that actually avoids the market instability and has the potential for some healthy returns, again according to your preferences and that tailorability and flexibility aspects there. So let's talk about how to get started once again. Now I'm going to jump across to the website now. So unless you're watching a recording somewhere else, you're probably watching this on the website right now, or you might even be watching a recording on the website. But that looks like that, as you can see. So you'd be watching the live session here, or the recorded session here. Now if you just scroll down, you can see some buttons here that will take you through to some of the more details there. So there's more performance details there. If you want to look a little bit further into the education/recommendations side of things, the hands-on side of things, you can do so there. And the broker, our preferred broker, our primary broker in fact, for all of these services is ACY Securities. So the first step you would do is you would set up an account with them. So there's a button there that will take you through to this page here, which talks a little bit more about ACY, benefits, stability, Tim Cahill, and a range of other things there. And there's a couple of buttons. In fact, this is the button you want at the top that would allow you to open up an account with ACY Securities. So you establish the account with them, and then we can apply some services to that account for you. And so if you follow these account opening links there, it takes you through to this one here. There's Tim again, and the first thing you do is you just select your account type. Now if you're just looking at setting up under your own name as an individual, you just select your personal account like so. If you're looking to set up under a trust or a company, or under an SMSF, okay, which absolutely is an option, about 45% or so, even more of late, in fact, probably about 65% of our clients, I would say, of late at least, are opening up under SMSFs. So to do that, you select the business option there. So I know that an SMSF is not a business per se, but in terms of the structure and the application, you just go through it as a business effectively, because it's a non-personal entity. So you just do that, select your country, and so on, and the rest is sort of self-explanatory. But just let me know, or let ACY know, if you have any snags or questions or complications on the way through. We'll help you out. So that's it. The first thing to do, just to sort of recap there, is to set up your own fully independent account. It's your account. It's separate from everybody else's. And once again, you're really just setting this up in the exact same way as if you were going to trade it yourself, or manage it yourself, I should say. And then you deposit your initial capital into the ACY Commonwealth Bank Client Trust Account. So once you've done that, it then appears in your account and you get your logins and you can see everything there. And then the final step is to then authorize Investor Unity to connect your account to the MSP service. So once again, that's a 2-minute online form, and that just authorizes us to connect your account to the master strategy portfolio. Once again, so that if we, when I should say, we place a buy or sell order for ourselves and for the rest of our clients, you receive that on your own, fully separate, fully individualized account as well. And you get your logins and you can monitor things and print out your statements and add funds and withdraw funds and basically do whatever you want. It's as simple as that. So that's really it for now, ladies and gentlemen. I do appreciate your time. We've covered a lot tonight, and so yeah, do reach out for any questions or additional clarifications whatsoever. Otherwise, we do wish you successful trading and investing. And again, you just scroll down the page there and you can find some getting started buttons and links and additional information and everything else. And my contact details there are below as well if you want to get in touch for additional assistance or whatever it may be. But that's it. Thanks very much for coming along, and bye for now.